Every investor thinks they're early. Michael Saylor believes we're earlier than anyone even realizes. In his latest interview, he explains why 2025 isn't just another cycle. It's the first year of the institutional Bitcoin era, a turning point where Wall Street, banks, and governments stop treating Bitcoin like a trade and start rebuilding the financial system on top of it. Saylor argues that the game has already changed, politically, financially, and structurally. The ETFs were just the spark. What's happening now is a full transformation of money itself, and at the center of it all, Strategy, a company that started as a software firm and is now quietly becoming the world's first Bitcoin bank. Before we talk about the future, it's worth understanding how we got here. For 5 years, Strategy has been buying Bitcoin relentlessly. But what Saylor revealed in this interview is a new phase entirely. They've just become the first Bitcoin treasury company rated by S&P. This might sound like a technical milestone, but it's historic. It means the traditional credit system, the same one that underwrites trillions in bonds, mortgages, and corporate debt, is now officially recognizing a company whose balance sheet is built on Bitcoin. Let's hear how Saylor described it.
First and foremost, congratulations on becoming the first Bitcoin treasury company to be rated by S&P. How does it feel and what does it mean?
Well, I think it's a very legitimizing step. It's auspicious for the industry. This year, we launched 4 digital credit instruments, Strike, Strife, Stride, and Stretch. They were all IPOs. They all publicly trade. Those are backed by Bitcoin. And they've been very successful, but they've been unrated. And so many fixed income investors and insurance companies and large pools of capital, they would like to buy them because they have superior yields. They're really cool instruments, but they can't without a rating. And so part of the maturation of the entire asset class is getting the traditional credit rating agencies to begin to acknowledge digital credit. And this was the first credit rating of a Bitcoin treasury company ever in the industry. And we've been at it for 5 years, so I think it's a big milestone.
The implications are massive. Until now, Bitcoin products have lived outside the fixed income world. Pension funds, insurers, and sovereign wealth managers simply couldn't touch them. A rating changes that. It opens the door for Bitcoin-backed credit to flow into the same portfolios that hold US treasuries. And for the first time, yield hunters can access a digital asset with institutional compliance and transparency. For Saylor, this is step 1 of banking Bitcoin, legitimizing it in the language Wall Street understands best: credit ratings and yield curves. Saylor knows the biggest barrier to adoption isn't ideology, it's volatility. Bitcoin has averaged 50% annual returns since 2019, but it's 3 times more volatile than the S&P 500. Most investors can't stomach that kind of ride. Strategy's solution? Transform that volatility into cash flow. They buy Bitcoin, then issue over-collateralized credit instruments that pay 8 to 12% yields. These instruments allow investors to choose how much upside they want and how much risk they'll tolerate. Here's how Saylor explains the model.
The history of Bitcoin for the past 5 years is it's been appreciating about 50 to 55% a year, and it's been about 50 vol, so 3 times as volatile as the S&P index. If what you wanted was 50% ARR and 50 vol, then you would just buy the raw commodity. But it turns out that if you walk down the street and you ask people, would you like to generate 50% returns a year, but you might wake up and lose 25% of your capital in 1 week? Most people don't want that. So they don't like the volatility. What our company does is we buy Bitcoin, and then we issue credit instruments against Bitcoin. So for example, some people would like to have 75% of the upside, 5% of the downside, and an 8% dividend while they wait. That's a convertible preferred, and that's what Strike, STRK, is. It's most of the upside of Bitcoin, very little downside. It's like 6-7 times over collateralized, and it's a dividend. Other people, they don't want that. They just want, for example, 10% dividends forever. I don't care about anything more than that, but if you pay me 10% dividends forever, that's interesting. So we just take an asset that's very volatile that we expect Bitcoin to go up 30% a year for the next 20 years. Mm-hmm. We expect it to go up more than 20% forever. So it's not a problem for us to give 10% dividends because that's our business model. But For the investor would like to see that we're 5x or 10x over collateralized, right? So for every $10 billion of Bitcoin we own, we might sell $1 billion of that credit with that $100 million a year dividend stream. And so you're the credit investor, you're just getting that pure yield. And from our point of view, we're paying 10 and we're getting back 20 or 30, right? So it makes sense for us.
What he's describing is the financialization of Bitcoin, the same process that turned gold, oil, and real estate into trillion-dollar collateral markets. Strategy expects Bitcoin to appreciate 30% a year forever. If they can pay 10% to investors while capturing the remaining upside, the math works. It's the same playbook banks use every day. Take a volatile base asset, slice the risk, sell predictable yield, and keep the spread. Except this time, the base asset isn't debt. It's the hardest money ever created. In effect, Strategy is building a Bitcoin-based credit market where the underlying collateral outperforms the instruments built on top of it. That's how you bridge Wall Street and crypto without asking anyone to buy a wallet or learn self-custody. Numbers speak louder than theories. Right now, Strategy owns roughly 640,000 Bitcoin, about 3.1% of all that will ever exist. To put that in perspective, if Saylor's company were a country, it would rank among the largest sovereign holders of gold, except the asset it holds is digital, portable, and finite. Here's how he described their accumulation engine.
There is so much to unpack there, Michael. I mean, you just talked about, how much Bitcoin you have, $75 billion. Just talk to us about how much that actually represents and what's your end game here?
Well, we own about 640,000 Bitcoin, and that's about 3.1% of the network. 3.1% of all the Bitcoin that will ever exist, we have acquired. Most of that we've acquired with equity capital, about $50 billion plus of common equity, about $6 billion worth of preferred equity. And so the company is substantially equity, and our primary business line is to issue this credit instrument, and every year we sell a bit more equity and we sell a bit more preferred equity and we buy more Bitcoin. So like this week we bought like 390 Bitcoin. Every week we'll acquire a bit more, and we just continue to grind up. And as we do that, Bitcoin becomes more scarce. And because we're buying so much of it, that means the price over time has to appreciate because all the natural sellers get taken out of the market and no one wants to sell unless you raise the price for it.
Every week, Strategy adds more Bitcoin. Most of it is financed through equity and preferred share issuances. Each round converts fiat capital into digital capital, pulling more Bitcoin off the market and locking it into long-term corporate custody. Saylor's logic is simple. Scarcity drives value. By consistently removing supply, Strategy accelerates that scarcity. He compares it to a corporate DCA machine, absorbing sell pressure while institutional demand builds behind the scenes. And because the company is now rated and regulated, it becomes a gateway for conservative investors who want exposure without direct ownership risk. This is how Bitcoin slowly migrates from speculative markets into balance sheets, pension funds, and endowments. At the core of Saylor's worldview is a single idea. Bitcoin isn't just digital gold, it's digital capital. He calls it a bank in cyberspace that anyone can access, with 21 million coins acting as its permanent monetary base. Listen to how he frames it.
The best way to think about Bitcoin is it's the world's first example of a technology that allows individuals or corporations to tightly bind economic energy to their person. Like if you have 100 families and they all have some money, but they don't trust each other, they don't trust their bank, they don't trust their government, they don't trust any company, but they want to keep their money. So they come up with the idea of a digital bank. You write it in software, and the digital bank has 21 million coins, and anybody can buy any amount of the coins in the bank, and that becomes their bank in cyberspace. Now the question is, who runs the software? Well, I might trust you, but I won't trust your great-great-granddaughter. So we all run the software. Everybody runs the software, and then the software continually cross-checks everybody else. And so it's a very elegant, decentralized way to create a property network or a decentralized banking network. It's a protocol for economic prosperity, right? So it's like you speak English, I speak English, we can communicate. You use Arabic numerals, I use Arabic numerals. We could do math together. When you offer me nine bananas, I know what 9 is, right? Because we both use the same numbers in the same language. Well, what if we want to trade together and we don't want to rely upon any government or any bank, and we want to do it for 1,000 years? So Bitcoin represents that breakthrough. It's the first time in human history that an individual can own anything without asking the permission of someone more powerful than them. If you have 1,000 Bitcoin and you have the private key, nobody can take it away from you. You can carry it with you. You can send it anywhere on earth. You can take it with you to the grave. You solved the problem that the pharaohs in Egypt couldn't solve. How do you take your money with you, right? So that's a big idea. Let's just call it a bank in cyberspace where you put your money and no one can steal it. And it's currency in the sense that there's never going to be more than 21 million. So when you buy a Bitcoin, you're buying 1/21 millionth of all the money in the world forever. That's the idea. What do we call that? I call it the world's reserve capital network, right? It is capital. What is capital? Long-term store of value. You're a rich person. Where do you save your money for the next 100 years? Not in a currency. You don't buy pesos, you don't buy euros, you don't buy the US dollar, you don't buy the yen. If you're a rich person and you want to save your money for 100 years, you're buying equity, private equity, public equity. Maybe you're buying scarce desirable art. Maybe you're buying real estate, commercial real estate. So the capital assets of the 20th century were like the S&P 500 index, or New York or London real estate, or maybe sports teams if you're lucky enough to be able to buy one. But what Bitcoin represents is digital capital, right? If I have a bank and it's a network, a bank, I can move the money. I can move $1 billion from here to Tokyo in a few minutes. So then that way it's a network. But it's also capital itself. If I gave you $10 million and I dropped you in the middle of Africa, and I said, buy anything you want, buy any equity, buy any land, buy anything, buy any bond, buy anything, but you got to keep it for 30 years in Africa. Or I said, or you could buy $10 million of Bitcoin, and by the way, you can send it to Singapore or London or Paris or New York in 2 minutes from your phone. Mm-hmm. I would submit to you, there's not a single thing you would buy in Africa. There isn't the capital asset that you want to give to your family or your great-grandchildren. The same is true if you actually talk to people in China. They don't want to keep their money in China. There's a law against removing it from China. In Russia, in Ukraine. If you talk to Europeans, they don't want to have their money locked down in any country in Europe, right? They want to have their money. Where do people want their money? They want it in the U.S., right? How about Brazilians, Argentinians, Venezuelans? Most of the world doesn't want to take all of their family's wealth and store it locally in real estate, local stocks, local currency, local banks. That's why there are laws against them removing the money. And the problem with gold is if you have all your money in gold in Africa, you can't take it through the airport. You can't take your, if you have all your money in gold in Argentina, you can't bring it out of the country. So the value of Bitcoin is it's digital gold. So if you have your family's assets in Bitcoin, you can take it anywhere you want. No one can stop you from removing it from the jurisdiction. And the more insecure you are about the country you live in, the bank you do business with, the nation state you rely on, or your economic future, the more desirable it becomes. So in a nutshell, Bitcoin represents property rights for the human race.
For Saylor, this isn't about speculation. It's about property rights. Bitcoin is the first asset you can truly own without relying on a government, bank, or intermediary. Gold can be stolen. Banks can freeze accounts. Real estate can be taxed or seized. Bitcoin solves all three. He describes it as Cyber Manhattan, a digital city where every coin is a parcel of real estate. Only 21 million parcels exist, and one day billions of people will want a piece. In that analogy, strategy is effectively buying up downtown property before the skyscrapers arrive. He argues that Bitcoin represents a civilizational shift, the first time economic energy can be stored, transmitted, and inherited globally, instantly and without permission. That's why he calls it the foundation of a new financial system, not just another risk asset. Saylor believes the real bull market doesn't begin when retail investors buy Bitcoin. It begins when institutions are allowed to. And over the last 24 months, that door finally opened. He points to 3 catalysts that changed everything. the ETF approvals, the political shift in Washington, and a major accounting reform. Let's hear how he breaks it down.
And it certainly has been gaining traction. I mean, crypto has got so many tailwinds this year. I mean, more regulatory clarity and support, more corporate adoption, institutional appetite, and also legislative wins. I mean, which one has been the biggest tailwind for the space, and what continues to drive it higher?
You know, there's been about half a dozen massive milestones in the past 24 months. The first one was the approval of spot Bitcoin ETFs in January of 24. And that sparked the explosion and the explosive success of IBIT, which went from $0 to $100 billion in less than 2 years, and it's the most successful ETF in the history of Wall Street. So that was a big deal, the endorsement of the SEC. The second big deal was the red sweep in November, when you had a pro-crypto, pro-Bitcoin administration. We went from one supporter in the cabinet, Gary Gensler was a Bitcoin believer, 1 out of 12, to all 12 cabinet members, the president, the vice president, the head of the SEC, the head of the CFTC, the head of the treasury, the head of commerce, the head of, RFK, the head of, the housing authority, Bill Pulte, Kelly Loeffler, and Howard Lutnick. So you all of a sudden have 12 positive cabinet members from one, and that was a big deal. The third big milestone was FASB's adoption of fair value accounting for crypto assets. Before that point, and that took place at the beginning of this year, beginning of 2025. Before that point, if you're a public company, you could mark down your losses on Bitcoin, but you could never realize the gains. Right? It's literally an asset where you could only lose, you could never win. Right? So the entire accounting rule was a deck stacked against you. And so fair value accounting meant that our equity, for example, went from 3 billion to 50 plus billion in 12 months. Right? But if it was not for fair value accounting, we would still have $3 billion instead of 50 billion. So that was very prejudicial and hostile accounting, and that flipped in January.
Each of these milestones removes one of the biggest barriers to institutional adoption. The ETF approvals gave Wall Street a compliant vehicle, driving record inflows and proving demand. The political realignment turned Bitcoin from a regulatory liability into a national interest, and the fair value accounting change made it possible for public companies to hold Bitcoin without being punished on their balance sheets. Together, they flipped the environment from resistance to acceleration. Saylor says we've entered a 4-year window where banks, asset managers, and corporations will start banking Bitcoin, using it as collateral, extending credit against it, and integrating it into global finance. He compares this to the early days of aviation. In 1903, humans first flew. By 1904, it was undeniable. That's where Bitcoin stands now. The infrastructure is in place, the institutions are aligning, and the next decade is the build-out phase. A digital gold rush where those who understand what's coming position early while everyone else waits for permission. After spending the entire interview explaining how Bitcoin will transform the financial system, Saylor finally answers the question everyone's waiting for. Where does he think the price is going? He doesn't hesitate.
Well, the consensus of all the equity analysts, and there's like a dozen of them that cover our stock, is north of 150,000. Our corporate guidance is targeted at $150,000 by the end of the year.
Right. Okay. And sort of looking further out, have you got a sort of a 2030 target?
I don't have a specific target, but in the 4 to 8 year time frame, I think Bitcoin goes to $1 million a coin. Mm-hmm. My 21 year expectation is Bitcoin appreciates about 29% a year for 21 years, and that leaves it at $21 million. Yeah. 21 years from now. So I think that Bitcoin will appreciate in the range of 29 to 30% a year for 20 years from this point.
His targets are bold but specific. By the end of 2025, $150,000 per Bitcoin. Within 4 to 8 years, around $1 million. Over the next 21 years, steady 29 to 30% annual growth, taking Bitcoin to roughly $21 million per coin. He's not talking about quick speculation. He's describing Bitcoin as a monetization curve, from commodity to collateral, from collateral to capital base, and from capital base to global reserve. At each stage, adoption expands, volatility compresses, and value compounds. In Saylor's view, we're still in the early accumulation phase, the point where conviction matters more than timing. And as banking infrastructure, credit markets, and institutional demand converge, these numbers become less fantasy and more math. Saylor ends the interview with a challenge. He says investors today are living through the digital transformation of capital markets, the same shift that turned photos, books, and music from analog to digital. In his view, Bitcoin will do the same to money, credit, and value storage. Those who study it now and act before it's obvious will be buying digital land in cyber Manhattan at a 99% discount, because this isn't another halving cycle. It's the start of something bigger, the institutional Bitcoin era.